following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome back to the show.
Well, thank you. Was I missed?
Yeah, Guy is not on vacation this week, so we can't make fun of him this week. He's right here. We developed this show to answer your financial questions. You know, so many financial shows out there, just a commercial to come to a seminar, to come to an appointment. We really try to teach you something you can use right now in your financial lives. You know, hopefully, obviously, we do it for a reason. We want business from it. There's no secret to that.
We'd like to earn your business, certainly.
But we think that we'll earn more business, and it's done that way for decades, by giving people information they can use, not just, a calendar of when my next seminar is going to be. So if you have any financial questions or you'd like to take advantage of any of our services, remember we offer a full retirement plan at no cost or no obligation, Social Security Optimizer that shows you how to take Social Security when you put in certain life expectancies and your actual benefit. All of that is no charge. It's 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. That's the easy one to remember. It's also McClureCapital.com and Victor McClure. They all go to the same place.
And I would add, if you're looking at a fairly high income in retirement, either through your required minimum distributions, through your 401k, pensions, combination thereof, we've had a good deal of success with helping folks convert some of their IRAs and 401ks to Roths, which with the tools we use and implement for a lot of our clients would provide, and I'll say this slow, tax-free income for life. Even if the accounts are exhausted, it can really make a big difference if you're in one of the upper tax brackets in retirement.
Yeah, a lot of people are concerned. They understand. Some don't know, but most of them understand that in retirement, the required minimum distributions that the government's going to make you spend down your retirement account.
So they can get their tax money.
Right. And a lot of times retirement accounts are a big share of your overall portfolio. That there are ways that you can maintain that wealth, even though the government's going to deplete a lot of it and it's out of your hands. It's all IRAs, 401ks, pensions are forced income streams whether you want to or not. So sometimes you can reallocate your assets a bit and maintain a lot of that wealth. And that's just a few allocation, retirement income strategies you can implement that really makes a difference as you get older.
And I'll give you an example. It's a little trick. We do it all the time, but if you're not dealing with this, it's not obvious. If you have a $500,000 IRA when you retire, how would you like to be able to put a $200,000 lump sum payment into that right as you're approaching retirement? Well, you sort of kind of can. If you convert that to a Roth, you're going to have to pay your taxes, right? And if you're in a 40% bracket, give or take, you're going to owe about $200,000 in taxes. Well, you can convert that IRA, that $500,000, and in the year that you do, it's now a Roth. It's income, so you owe $200,000 in a tax liability. Well, you don't have to take the $200 from that $500 you converted. If you're in a position to, you could take $200 from your other non-qualified money, which is almost analogous to being able to put $200,000 lump sum into your retirement account. So now you have the same $500,000, but it's in a Roth. It's not subject to RMDs. If you want to use it for income, it could be tax-free forever. It just allows you more options and neat options, if I could add.
And some of those, like $500,000, you probably get $50,000 a year tax-free from that thing.
That's right.
And that's even if your money runs out, you're still going to get $50,000 a year. But that's just some of the strategies. Remember, Roth conversions are good for people going to be in the high tax bracket now and maintain the high tax bracket later.
Not for everybody.
When you retire, if you're going to be in a much lower tax bracket because the paycheck stops, might not be the best plan. We have to analyze that, and we'll show you the difference. And a lot of people have this plan to do a Roth, and it really is against what they need to do.
That's right.
And so we'll help you determine that. Our number again, 972 715-2424, or go to ilovemyretirement.com.
And I'll throw out another little piece, just as a teaser. If you didn't want to pay that $200,000 on that same example, that first year, you can convert part of that $500,000 over a series of 3 or 4 or 5 years if you'd prefer, and that way you could stagger that tax liability that might make it easier to implement. Anyway, there's all sorts of neat things. Call us. We'd love to take a look, see if we can help.
There's a whole different world. We'll talk about this a lot on the show over the decades or whatever, but there's a big difference between your accumulation phase of your life and the distribution phase.
Absolutely.
We're experts in the distribution phase. Everybody tries to do the same thing, especially if you've had some success. In other words, I've been doing this managed program of these mutual funds, these index funds for all these years. That has nothing to do with the distribution phase. If you mess up in the accumulation phase, usually time will cure it.
It can.
Time just kills it if you mess up in the distribution phase. And so the strategies have to be different. And they cannot be the same. They're not even close to the same. The income phase of your life, living off your portfolio or adding to your portfolio every year, are two different phases, and the investments even can't be the same in most cases.
Reversible mistakes when you're young, like having all your money in the market, become irreversible as you get into the distribution phase.
Don't hesitate to call us at 972-715-2424. Okay, this week, market's getting a little bit shaky.
Are you going to predict for us when it's going to correct?
No, unlike anybody else, I will never predict what the market's going to do. I have no idea. And anybody that tells you they have an idea either has a screw loose or they believe their own BS,
But we do know it will correct. We just don't know when.
Right. Right now, the Bank of America Merrill Lynch Fund Manager Report found 83% of money managers believe the market is overvalued. 83%. Now, the last time that number got that high was 1999. And we know what happened later, right? I can't believe it wasn't that high. It actually spiked really high in 2006, 2007, before 2008 as well, but not as high as 99. This is the highest. You've got the PE ratio. Now, there's several different PE, forward-looking PE ratio, right, back-looking PE ratio. It looked like 25 when the historic average is 14. A lot of people believe the Case-Shiller index. It's a Case-Shiller PE ratio.
Correct.
Or the Shiller PE ratio. It's actually the Shiller. It's the Case-Shiller index for homes. That's the more popular one. But the Shiller index PE ratio right now is about 30 when it's had a historic average of 16. The difference between the Shiller PE and a regular PE is based on either future earnings or past earnings. The year, right? A year or so. The Shiller PE ratio is based on an average of 10 years. This takes a rolling 10-year period, averages the earnings, and then adds inflation to the mix. So it's inflation. So a lot of people think that's much more accurate. And what it has been over the long period of time is a really good indicator of what your future earnings will be. A high PE would indicate your future earnings the next 10 years is what they're trying to, 10 to 20 years. Next 10 to 20 years, you're going to get low returns in stocks. If it was a low PE, it would indicate a high return in stocks. Remember, we've talked about this on the show before. The PE ratio is just, think about it on a private company. Most you're ever going to buy a company is 7 times earnings or something, right? You bought this company, you put millions of dollars into this company, you get your money back over 7 years or 3 years or whatever. Private companies go for much less, some 1 times earnings. Public companies do go for more. It's usually 14 times earnings. But think about, would you buy that?
And I remember Amazon in the day, even today, but still.
Would you buy something that took you 30 years to get your money back? When you do that mathematically.
As a business, if you're going to looking to buy a business. No.
Who would?
No.
Nobody would.
And that's if you had control of it.
That's right. That's what you're actually looking at with these numbers. 14 years is hard enough to swallow. Right? But 30 years, they always have it. There's always a higher multiple when you have public companies versus private, because public, you'll get into areas where just more buyers than sellers make a stock price go up. So it's going to increase that PE no matter what. And you don't have that in the private world.
And don't get us wrong. We're not trying to scare you and tell you to get out of the stock market and all of that. But knowing that 83% of the money managers believe something is coming, knowing that the Case-Shiller index is at 30 instead of 16, or the regular PE is at 25 instead of 14, what do you do with that information? Well, let's go back to basics. Make sure your allocations are the way they need to be, because your stocks that have profited have become a larger part of your portfolio, so you need to rebalance. That's counterintuitive, but you need to do it. What's the second thing? Take your age, subtract it from 100, and that's the max that you should have at risk of the market. So if you follow those basic principles, I would add, make sure that your expenses are getting taken care of in retirement, but do those 2 or 3 things, and it should be better for you.
Yeah, after the break, we're going to go over the Employee Benefit Research Institute. Came out with a new study, and it talks about stuff just like you were talking about, what happens to people, what they do, and all that kind of stuff, and what a lot of people believe they're prepared for retirement, even if it's 10 years away, and they're really not. And they're going to show you specific examples of what to look out for and not to look out for, right? So stay with us, folks. Remember, you're listening to the Common Sense Investing Show on KRLD, our number 972-715-2424.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we talked about the Employee Benefit Research Institute, EBRI, whatever. It had a new study out that 63% of workers are confident they have enough to live a comfortable retirement. The one thing that's interesting to me is, you've ever watched this? I follow these kind of things. I guess I'm a nerd in that respect. But if the market's done a lot for a few years, confidence is high.
Oh, absolutely. Market
crashes, confidence plummets with it, right?
What am I going to do?
We haven't had a down year in 8.5 years. And so confidence is high. But the research from this same institute concludes a big percentage of people haven't saved enough, that their plans have too many holes in it. But they give a guideline. Here are a few signs, according to the Employee Benefit Research Institute, that you might not be in as good a shape as you think. Okay? Well, number one, you don't do periodic retirement checkups. Remember, we talked about it earlier in the show. The accumulation phase of your life and the distribution phase of your life are two different things. Saving is a cornerstone to any kind of sound investment strategy. But what happens is, when people don't do periodic checks, they really don't know if they're on track for anything. And they might think they're on track, like, I'm pretty sure this is enough because we really don't spend too much. And what they'll do sometimes is they'll take their hardest expenses, whether it's mortgage, car payment, whatever, gas bill, electric bill, and they'll say, well, I'm going to get more than that. But when in reality, they're spending double to triple what their hard expenses are. And unless you want to completely change your lifestyle when you get retired, you need to look at what you're actually spending. There's a lot of easy ways to do that. A lot of people nowadays, they put everything like on a American Airlines miles card or something like that, or an American Express. They've got a point system, and they can always track how much they're spending. If you've never done that, and you've kind of done a cursory, here's what my income I'm going to need in retirement, you might be having an eye-opening experience looking at what you're actually spending.
Well, and I would add, doing a periodic retirement checkup, what does that indicate? Well, it kind of intimates that you have a plan, right?
That you've had one first, right?
Yeah, so you have to have a plan. So we can help you with that. If you haven't, we do several drafts, if you will, and fine-tune it and get it to where it needs to be, and then we can do periodic checkups for you.
90% of the people we've seen over the last 30 years have no plan. They think they do.
Yep.
What they've found is, well, my broker, I've had him a long time, and he says, we've averaged 8%.
We'll be fine.
We'll be fine. I'm looking at, I've got $2 million, 8% is 160. I only need 100. That should be perfect. In actuality, it has nothing to do. The distribution phase, when you start taking money out of a fluctuating principle that's in the market,
absolutely,
it is a recipe for disaster. And you have to look at the actual hard numbers. Don't just listen to the person telling you what you want to hear. I hear it all the time. Well, I understand your plan is a little conservative. My guy says I'm fine.
Yep.
Because we're always going to make 8%. And if I'm just taking out 5, I'm fine. I can show you mountains of evidence. You take out 5 or 6% of your money, I don't care what the return is. You will go broke.
And understand, whether you go with, let's say, our plan or this other aggressive advisor's plan, the amount of money you have is the same. That's the real number.
Right.
If you do well with our plan, you just have more money.
Right.
If you don't do well with the other plan, you're broke.
That's right.
Where would you rather have the
You
margin
try to make
for
your
error?
worst case where you can't go broke.
That's right.
That's the one. You
But-
don't want to have the possibility of me going broke.
But I understand completely when you're shopping and you have a conservative plan that says you can withdraw maybe 5% a year, 50,000 on $1 million, and you've got someone telling you that you can have 8%, 80,000 a year per million. Well, I want the bigger one.
That's right. And they're not going to be there when you're 80
That's right.
and you're trying. Well, you're broke now. Well, that's too bad. You knew the risk when you got in there, right?
That's right.
They're not thinking about 20 years from now. They're thinking about right now, getting you to open an account now or keep an account somewhere. So keep that in mind. Also, number 2, this is from the Employee Benefit Research Institute. This is signs that you might not be in as good a shape as you think. You lack a disciplined investment strategy. You're trading too much, paying too many fees, too much confidence in your trading abilities. I've had people say, there's no way I can't make at least 4 or 5% a month. I was like, till you die. Yeah, oh yeah. So you're 86 years old. You're trading some stock option. I said, all I need to do is I just need to see the actual returns. You show me a 20-year track record where you've made that kind of return, a 10-year track record. And I'm going to, you couldn't have added money to this thing. A set account. Now, by the way, I've been doing this 30 years. I've never seen one once.
Tell you what.
Have you ever seen one once? You've been doing this 35 years.
Nope. And with any
No.
consistency?
No.
No. Peter,
Absolutely not.
yeah, the one managed account we had did well for 5 or 6 years. You know what popped out to me when you said that was paying too much in fees. One thing that we see a lot, especially in 401ks, because you're adding money weekly, biweekly, or monthly to that, it looks like your account's always going up. And unless you're really into it and the expenses and all of that stuff, you really don't know what your fees are. You need to know.
That's right. Incorrect allocation, taking too much risk. I have people all the time say, I take a lot of risk, and that's why I've got a lot of money. I go, and that's fine. But once you get that distribution phase, you're going to have to change it some. It's okay to be take some risk on a piece, but you need to hold away a couple because you don't ever want your worst case where you're eating cat food or working at, we're at the door somewhere, right?
That's right.
All right, number 3, this is from the Employee Benefit Research Institute. You plan to work a little longer. A lot of people plan to work a little longer in retirement because that helps your plan tremendously. It really does. But sometimes people use that as an excuse to save a little less, take a little more risk. What their research has shown, 50% of people planning to work longer could not because of illness, layoffs, family needs, whatever. So half of the people planning cannot do it. So that's one plan that you might not.
It's not a good plan.
That's right. We got a break coming up, folks. Remember, don't hesitate to call us if you have any financial questions, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
That's right. I'm experienced. Guy is old. Just remember.
Where did that come from?
Because when I keep hearing that, I'm like, man, that means we're both old. That can't be. I'm barely 30, right?
I was talking to my mom, and she listened to the show last week when I was gone. She goes, that show was really good. She goes, you and Victor cut up too much. She goes, it was serious. It was to the point. You were talking about finances. I like that. So
yeah.
That was for you, Mom.
All right, we're talking about the study from the Employee Benefit Research Institute that said, 63% of workers are very confident that they'll live a comfortable retirement. Yet their research keeps showing that really most people aren't prepared. They said there's 5 things you'd look out for somebody that's really not prepared. One of them is you don't do periodic retirement checkups if you've done any at all, which you don't have a disciplined investment strategy, which happens a lot. And remember, even more important, a distribution strategy, which could be completely different. It's a big difference than when you're accumulating money when you're starting to distribute it.
As many people that don't have a true retirement plan, I feel in my heart that even more don't have a distribution strategy.
Oh, yeah. It's 99% don't have a distribution. 90 don't have a retirement plan. But what they've got is they might have a financial plan,
Yep.
Financial planning has nothing to do with distribution. There is a part of financial planning that does that, but they don't ever concentrate. They just basically throw everything in the accumulation pile and hope it works out.
Their distribution strategy
Yep.
is Social Security.
Yeah, and stay with what you're doing. Whatever it is, stay with what you're
That's
doing.
right.
It's
That's
a
right.
fee-based managed account. Stay with that account forever, and you'll be all fine. We talked, so it also talked about people planning to work longer, but 50% of people that plan to work longer can't work the longer. They're not allowed to, either illness or they don't get hired. You go to these companies, they're not supposed to discriminate against age. You be a 60-year-old and go up to one of these tech companies. Now, if it's a small company, you just destroyed their health plan, right?
Absolutely. That's what I was thinking.
They got 5 young kids, and
That's right.
you come in there and like, oh, you just doubled their premium.
That's right.
So you tell me they don't discriminate. They usually want it. This is unfortunate, especially since we're both getting towards 60. They want to get rid of the high-paid people and get the young ones in there. It saves them so much money, right?
We've got several friends in the corporate world here in Dallas that 6-figure paying jobs that actually trained
Train their
2
replacement.
people, juniors.
Yes.
And after they trained them, they got the call, got laid off, and then 3-4 months down the road, they get contract labor. So what do they eliminate? All the benefits, all
the
those
benefit
excess
costs.
expenses.
That's right.
That's right.
But sometimes it's not a bad deal. Sometimes they'll pay enough contract work numbers. It's
Well,
not
those
as
people
bad.
our age, mid-50s. I mean,
Yeah.
that's not when you want
Right.
to get forced retirement.
There's also number 4. You plan on working through retirement, either full or part-time. Okay.
And the survey says
70% of people have this as part of their retirement strategy. All right. You know the number that actually works through retirement? 25%.
that's low,
Probably
right?
for some of the reasons we talked about.
Yeah.
And number 5, the last reason why most people are ill-prepared, even though when the market goes up 8 or 9 years in a row, 60-70% feel very confident right
Sure.
now. Number 5 is you don't have a plan to turn savings into income. That's what we're talking about, the accumulation phase to the distribution phase of your life. You have to draw up a budget. You've got to factor in inflation. You got to set a reasonable withdrawal rate. You have to ensure you don't run out of money. You have to stress test the portfolio. I can't emphasize this enough. If you do not stress test your portfolio, you don't have a plan. You don't have a retirement plan. You don't have a retirement income plan. All you have is a hope.
And
I hope it'll always make 6 to 8%.
And if you're not sure what the best tool is to provide you the most amount of income, give us a call. There's lots of tools out there. The market's good for what it does. Bonds are good for what they do. CDs, annuities. There's a whole universe of things, but certain things really excel and perform better at different tasks, and you need something special for this task.
When you would have, at 30 years old, wouldn't or shouldn't consider
Right.
certain types of investments.
Exactly.
At 50 years old, that starts changing. At 60 years old, that changes again. If you're about to retire, it changes again. Because what you look at is the most efficient thing to distribute funds and maintain wealth that you can possibly do. I don't care what it's called. And that is what a real retirement income plan is.
And it doesn't matter if you have 500,000 or 500 million, it
Right.
will help your results.
Oh, absolutely. And that's everything we do here is based on math and mathematics. Being a former nuclear chemist, it's got to be math. I've heard 1 billion sales pitches. Some of them sound pretty good. Some of them sound terrible. Most of them aren't rooted in math. Like they'll have this, I remember these guys selling these universal life policies 40 years ago. Oh my gosh, if you make 15% a year on it, blah. Of course it didn't make anywhere close.
Their examples are based on 7 or 8%.
Oh, just awful
Yeah,
stuff.
every year.
Yeah, and it never works out, ever, ever. So you have to have a plan that's based on reasonable expectations, and then you stress test it. Because I don't want something happen where somebody gets in the White House or something happens to Congress or North Korea attacks South Korea, whatever. All of a sudden, I'm broke. Don't forget to call us. We'll be more than happy to look over your situation, 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Remember, don't hesitate to call us if you have any financial questions. If you'd like to take advantage of our retirement plan, the most detailed software I have ever seen. Factors in taxes, inflation, Social Security cost of living adjustments, adjustments to expenses as you get older, all those kind of things. 972-715-2424. You go to ilovemyretirement.com. I got a few calls from last week's show that was talking about they enjoyed me talking about my personal stuff. Not that I'm a Taurus or anything like that, but my life story on this stuff, and we talked about it a little bit last week. I'll share a little bit more. People know I was in the military for 6 years. I was a nuclear chemist. I was in charge of the Ford Group reactors on the USS Enterprise. Unfortunately, the USS Enterprise has been decommissioned since then. And remember, it was old when I was on it. And then I'm just briefly going over what we talked about last week. In 1988, my father, I was going to work for a nuclear power plant. I was hoping to work for the one here in Texas, Glenrose. And he said, why don't you give this a try first? And I gave it a try, and it wasn't working so good. The first
This
month
being
or so.
financial.
Yes. He was a commodity broker. Back then, they didn't call them financial advisors. You had the stockbrokers and commodity brokers. And people don't realize this commodity market is actually about 100 times bigger than the stock market.
Absolutely.
It's just different, right? More individuals invest in the stock market, but more corporations, countries, banks, and all that invest in the commodity market. So,
did you tell him if you just stayed the course?
Yeah.
At 38, you could retire with full pension from the Navy,
Yeah.
and then you could start the financial career?
The 38 years old, I thought at the time, when you're a kid,
Oh, yeah.
I would be a grandpa. Who'd be that old? I'd be dead by 38, right?
That's right.
But I did not take the retirement. I just did my 6 years and hightailed it out of there, right? But I did this. I didn't do too well the first month. I heard my dad talking to my grandmother, and my grandmother was my world. She was my favorite person, lived in Greenville, Texas. Favorite person on the planet. I was the oldest grandkid. Maybe that had something to do with it. She always cooked me a whole fried chicken. You know, I can barely eat 2 pieces now, but I could eat an entire fried chicken when I was younger. She always cooked everything for me, and I love it. But he was telling her, the Navy's ruined this kid. That engineering crap. He talks like a nerd, and he can't do anything. I got to get this kid a job. He can't give away bread in a famine. Well, I overheard this. When I just turned down a pretty high-paying job or had a lot of to work in a nuclear power plant, and I said, oh, I have never failed at anything. I cannot believe saying that. Well, after that, I became his top broker at the time, and there's probably 50 of them. And we had a contest every month who won, the most, did the most, and I only lost it twice. I even remember the person I lost it to 2 of those months of the next few years. It was John Sippel. He was a big German guy. The funniest thing you've ever seen in your life. Big German guy.
I'm a big German guy.
Right?
What's your point?
He was probably about 6'6", about 300 pounds, just a big old guy. And he did beat me a couple times. I remember that. But I've learned really quickly that commodities weren't for me. It's much more of a gambling type of thing, You send in $100,000, you might owe them $100,000 before that check is even cooled off a little bit. Too much for me. I learned I wanted to be something safe, so I started doing, stocks and bonds and things back in the early 90s. I started doing the commodity thing in the 80s, and I started doing that in the early 90s. And it's been a fantastic career. I think I'm helping people. It always works. It's got me through a lot of times. I had cancer, I had kidney cancer. Gosh, what is it, 7, 8 years ago now? And my daughter had just been born. Now, I've got 4 children, one 31, all the way down to 8 years old now. She's almost 9. But I had cancer right when she was born. And they thought it spread and all these things. They took out my left kidney, but thought it spread for about 2 or 3 years. I pretty much thought I was going to croak.
I got to interject. They tell Victor that he's got cancer, and he needs to have surgery right away. So what does he do? Oh, no. He goes to Hawaii for a week first.
Well, they told me it was a slow-growing cancer, so I've had it for a while.
Right.
So, all right, I don't want to change my plans. That plane ticket was a lot of money. Oh, I know. The old owner of Dillon Gage, Steve Miller, goes, "You're doing what?" I've got friends down at, what's the place down in Houston?
MD Anderson.
MD Anderson. No, you're going to go down there. I said, no, I'm going to Hawaii. I'll be back. So I came back, really went the thing. And they love it around here because I tell them I only missed 2 days of work when they took a kidney out, and that's because they wouldn't let me out of the hospital for that 2 days. So my wife loves it that I'm a workaholic. I'm only kidding. She doesn't like it at all. But that's the way it is. I'm going to work till I die. That's just the way it is also. Plus, I'll be, by the time my daughter gets out of college, I'll be in my 70s or something. So that's the way it is. So that's a little bit about my personal stuff. We're going to go over your questions here. I think we got time to start one. Guy, what do you think? Remember, anytime we get questions from personal interviews, emails, phone calls, if I think it's going to appeal to a broad audience or we hear it a lot, we're going to share it with you.
All right, here we go. Question number 1. Some people like mutual funds. Some like managed accounts. Some like ETFs. What is the difference?
Well, the difference, mutual funds are, some are managed, some are not managed, right?
Right.
Index funds are also mutual funds, but they're unmanaged mutual funds. The main difference is forever they just had retail funds.
It could be stocks, it could be
That's
bonds.
right. American Funds, I think, is the biggest distributor of retail mutual funds. And then what happened was Bogle came out. His name is John Bogle, goes by Jack, I believe. He came out with Vanguard and got really low index fund fees. And so then you started getting things like ETFs, which are kind of the brokerage industry's answer to an index fund. We could talk about it in more depth after the break. But remember, mutual funds, managed accounts, ETFs are just different forms on how to hold stocks. Okay? Most of them are baskets of stocks. Sometimes they change, sometimes they don't change. We'll go more after that. Remember, stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Remember, don't hesitate to call us if you have any questions. If you are a little bit uncertain that your retirement plan is real. If somebody told you as long as you make 8% a year for the rest of your life, that ain't a plan.
You're in good
So
shape.
call us at 972-715-2424. Or you can always go to our website, ilovemyretirement.com. All right, Guy, what were we at? Oh, we were talking about
We were talking about mutual funds, managed accounts, and ETFs and the difference thereof.
Right. I'm a big fan of index funds. Always have been. Own them right now.
And ETFs for that matter.
ETFs. Difference. ETF, sometimes the fees are a little bit higher than a mutual fund. You got to be careful there. Make sure you get really low ETFs. But exchange traded fund is an ETF. And what it does, it can be the Vanguard 500, the S&P 500, which Vanguard 500 invests
Which
in
is
that.
VOO if you're looking at Vanguard.
There's SPX is the futures version. But that one basically gets 100%. It's in 80. It's the valuation of the S&P is about 500, about 80% of the U.S. stock market. It has every sector of the market in it. So that's the Dow Jones is not a good indicator of the market, even though they do go kind of hand in hand.
They sure use it, right?
All right. But an ETF, you can trade intraday. So if I see something happening in the market and I want to sell an index fund or any mutual fund, and say I put in the order at 10 o'clock, it will sell at 3 o'clock. So you're going to go through whatever day's gyrations, up or down, and you'll sell it then. With an ETF, you can sell it instantaneously.
Yep.
And a lot of brokerage firms have, free ETF trades even. So that's not bad. So right now I lean a little more towards ETFs, but if I can get a really low fee index fund, I'm okay with that too. Just remember, index funds are fantastic, but might not be the best way to distribute your funds later. They're great at growing money. Fantastic. All my managed accounts are in ETFs.
If you're in the right ones,
Yeah.
absolutely.
Nothing wrong with ETFs. Anybody tells you they don't like index funds or ETFs, they're automatically, everything they say from this point forward is suspect to me. It's not advice I want to take. I know they may be selling mutual funds, but to say an index fund isn't a great investment is something crazy. No, get me wrong. It's got the full risk of the market. But as far as if you're okay with the risk of the market on investing in something, there's nothing wrong with it at all.
And like we've always said, you don't put all your money into anything.
Right. All right, what's our next question?
All right. Here's a doozy. You
Uh-oh.
ready?
Yep.
Safety belt on? Why does Ken Fisher hate annuities? You going to give him a short answer? Because he doesn't get to manage the money.
He loves selling. He sells something else, a competing product.
Yep.
He has a managed program.
I will tell you while you're gathering your answer there, the problem I have with Ken Fisher and his ads, about I'd rather burn in hell than invest my money in annuity, and that's exactly what he says. He spends millions of dollars, probably weekly, nationwide with these, and everybody hears them so much. I've got a couple doctors I'm working with, and they hear this so much. They're afraid that they may make a mistake. Who was it? Lincoln that said if you hear a lie often enough, it becomes the truth.
Oh, yeah.
I don't know if it was Lincoln or not, but he spends all this money, and it's in the back of your head, and it is fake news.
Right. Anytime I hear, well, remember, there's a lot of different kind of investments. There's mutual funds, there's stocks, there's managed money, there's bonds, there's municipal bonds, right? There's all kinds of different investments. Annuities. There's nothing fake about any of them. There's nothing bad about any of them. They have different benefits. There's pros and cons.
You know what would make that statement accurate? If is, I would burn in hell before putting an investor in annuities for solid growth.
Yeah, yeah.
You know, when risk isn't, or for an inflation hedge, then it kind of makes sense.
Right. And like I said, I've dealt with a client just recently that said that they've averaged 6 to 8% and said you can take out 6% a year and you'll be fine. That was Ken Fisher's people. And I go, their own 15-minute retirement plan says you can't take out more than 3, maybe 4 if you're real lucky. Yet they just told you to take out 5 or 6. They're just trying to get the account. I go, the what you call it, Forbes, which he's a columnist, and I'm picking on him. Believe me, I do not want to get in a war with Ken Fisher. He's got a whole lot more money than I do. I don't want to get in, but they rated the returns. The returns have been under the market. So we already told you the market's made 4.06% a year for the last 17 years, and so maybe it's made 3, 2.5. You got it. So he'll talk about, well, you pay too many fees in annuities. Well, there's only one kind of annuity high fees, and I agree you should never do it.
Variable annuity.
Variable annuities, that the fees are too high. Now you can get some low fee variables, and they're not bad. TIAA, CREF.
Yep.
Not bad. So you can get low fee variables. They're not bad at all because they give you other benefits like tax deferred, judgment proof, avoid probate, all that stuff. So they're not bad. But to say I'm going to charge you 1.5% a year on my managed program, and that somebody that makes an average of say 5% on an annuity is somehow the devil. Think about 1.5% a year on a growing asset over 10 years, or somebody makes 5% up front that you didn't pay it. The insurance company pays them. The advisor, nothing comes out of your money. The 1.5% a year comes out of your money. Now that is, if you never make a dollar, is 15% of your principal goes to them. If you make money, it'll be like 25%.
We had lunch Thursday, Victor, and you were talking about a client. I forget the backstory on it, but you said he had averaged 7 or 8% every year on his fixed annuity. What was the number?
It was 7.6, something like that.
7.6%.
You know,
now, that's
person,
not why you do it, and
no.
you can't base your retirement on that, but you can get some good numbers.
No. All I'm trying to do is I just use things as fixed income alternatives. You know, I need something to effectively distribute my assets when I retire, but I also want something that's safe that gives me a specific return. Well, that's our show, folks. I want to thank everybody for listening today. Remember, if you have any financial questions, like any free information kits, we've got a lot of information we can send you. It's 972-715-2424. Again, don't hesitate to call us, 972-715-2424. You can always go to our website at ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.